4 years ago, a 36-year-old teacher in Phoenix sat across from a financial advisor and said something most people never say out loud. She said, "I know myself, and I know that if I can see the number and touch the money, I will eventually make a bad decision with it." She was not in crisis. She was not behind on bills. She was not recovering from a financial mistake. She was sitting there with a modest but growing portfolio, a stable income, and a level of self-awareness that most people spend their entire lives avoiding. She knew that her greatest financial threat was not the market. It was not inflation. It was not her income. It was her own access to her own money. So they built something around that truth. A structure. Not a strategy in the traditional sense. Not a hot stock pick or a rebalanced allocation or a new savings rate. An architectural decision that removed her from the equation at the exact moments she was most likely to destroy what she was building. And she has not made a single emotional financial decision since. Her net worth has grown every year for 4 consecutive years, including the 2 down years in between. This is not a story about discipline. The wealthy figured out a long time ago that discipline is not a reliable financial tool. It runs out. It gets tired. It fails at 2 a.m. when the market is down and the news is bad and your stomach is telling you to do something. What doesn't run out is architecture. And today we are going to break down exactly how it works, and why the people quietly building generational wealth are using structure to do what willpower never could. Here is the uncomfortable truth that sits underneath almost every financial mistake ever made. People do not fail financially because they lack information. They fail because they are human. Because the same emotional wiring that kept our ancestors alive, the hair-trigger threat response, the compulsion to act when things feel dangerous, the desperate need to do something when watching feels unbearable, is catastrophically mismatched with the patient, boring, counterintuitive requirements of long-term wealth building. Dalbar research has tracked investor behavior against market returns for 30 consecutive years. Their conclusion is one of the most sobering statistics in personal finance. The average equity investor has underperformed the S&P 500 by nearly 4 percentage points annually, not because they picked bad stocks, not because they paid too many fees, not because they started too late, because they sold at the wrong moments, repeatedly, predictably, almost universally. 4% annually sounds manageable until you run the numbers. On a $200,000 portfolio over 30 years, that behavioral gap is the difference between retiring with $1.1 million and retiring with $3.8 million. The market did not fail these investors. Their own access to their own money did. The wealthy solved this problem decades ago, not with better information, not with stronger willpower, with architecture, with structures, agreements, vehicles, and legal frameworks specifically designed to make the emotionally driven financial decision either impossible or painful enough to pause. And once you understand how that architecture works, you will never think about financial discipline the same way again. Sarah, the teacher from Phoenix, did 3 specific things when she sat down with her advisor that afternoon. And each one represents a layer of the same architectural philosophy that quietly wealthy people have been using for generations. The first thing she did was introduce friction. Not metaphorical friction, actual, contractual, time-delayed friction. She set up a mandatory 60-day cooling-off period before any withdrawal or liquidation above 15% of her total portfolio value could be processed. Not a reminder. Not a gentle nudge from an app. A legal requirement baked into her account structure that meant if she wanted to make a large emotional move with her money, she had to want it consistently for 60 days before it could happen. Research from behavioral economist Richard Thaler, who won the Nobel Prize specifically for his work on human financial decision-making, shows that cooling-off periods of as little as 30 days eliminate over 70% of emotionally motivated financial decisions. People simply stop wanting what they wanted in the panic. The friction is the strategy. But here's where it gets interesting. The second thing Sarah did was remove the number from her daily sightline. She asked her advisor to send a single quarterly summary. No app, no real-time dashboard, no daily account access. This sounds almost primitive in an era where you can check your net worth every 30 seconds from your phone. But the data on this is unambiguous. A 2021 study published in the Journal of Financial Planning found that investors who checked their portfolio daily made significantly more trades, held assets for shorter periods, and achieved materially worse returns than investors who reviewed quarterly or less. The number is not neutral information. Every time you look at it, your brain evaluates it as either a threat or a reward and begins building a case for action. Removing the daily number removed the daily case for action. Sarah stopped reacting because she stopped having things to react to. The third thing she did is the one that surprises people most. She made large financial decisions structurally require a second signature. Working with her attorney, she set up a framework where any financial decision above a certain threshold, moving money between accounts, liquidating positions, taking on new debt, required co-authorization from her advisor before it could be executed. Not permission, co-authorization. A structural speed bump that meant her worst financial impulses had to survive a conversation before they could become actions. This is the same principle behind the irrevocable trust structures that wealthy families have used for generations. Not to hide money or avoid taxes, but to insert deliberate human friction between an emotional moment and an irreversible financial decision. But here's where it gets interesting. Because what Sarah built is actually the entry-level version of something the genuinely wealthy have been doing at a far deeper architectural level for a very long time. And it connects to a concept in the tax code that most financial advisors never explain clearly. And that changes the entire calculus of when and whether to ever sell an asset at all. It is called the stepped-up basis, and it is one of the most powerful and least discussed wealth preservation tools available to any investor at any level. Here is how it works. When you buy an asset, a stock, a piece of real estate, a business stake, and it appreciates over time, you owe capital gains tax on that appreciation the moment you sell. But if you hold that asset until death and pass it to your heirs, something remarkable happens. The cost basis of the asset resets to its current market value at the time of inheritance. Every dollar of capital gains tax owed on a lifetime of appreciation disappears. Completely. Legally. Automatically. To put real numbers on this, if Sarah buys $10,000 of an index fund today and holds it for 35 years while it grows to $240,000, she would owe capital gains tax on $230,000 of gains if she sells. At a combined federal and state rate, that tax bill could exceed $50,000. But if she holds it, passes it to her children, and they inherit it at its current value, that $50,000 tax obligation does not transfer. It evaporates. The IRS calls it a stepped-up basis. Wealthy families call it the most reliable tax strategy ever written into American law. And the only thing required to access it is the same thing Sarah's architecture was already designed to produce: holding. Patient, structural, almost stubborn refusal to sell. But here's where it gets interesting. The stepped-up basis is not just a tax strategy. It reframes the entire question of when selling is ever the right decision. Because once you understand that every year you hold an appreciated asset, you are building a tax-free inheritance, and every time you sell, you are voluntarily handing a portion of your compounding to the government, the math of holding becomes almost impossible to argue against. The wealthy don't hold because they are patient. They hold because they have run the numbers far enough into the future to see what selling actually costs. Not just today, not just the capital gains bill, but the compounding on the tax payment that never happened, the inheritance that arrived intact, the generational wealth that transferred without friction. Sarah has not touched her portfolio in 4 years. Not because she is disciplined, because she built something that made discipline unnecessary. The structure held during the 2022 downturn when her colleagues were panic selling. It held during a personal financial scare 18 months ago when her gut told her to liquidate and start over. It held because it was designed to hold, not to rely on her to be stronger than her own fear. Architecture over willpower, friction as a feature. Holding not as patience, but as the most mathematically sophisticated financial decision available to any investor. And a tax code provision that rewards exactly that behavior with one of the most generous gifts in American financial law. But here is the question worth sitting with tonight. If the structure is this powerful, if removing yourself from the decision is this effective, why does nobody build it until something goes wrong? There is a specific answer to that question, and it has everything to do with how the financial industry is structured to profit from your activity rather than your stillness. That is exactly what the next video covers. And if this one changed how you think about your own money, that one is going to change what you do about it.